페드가 금리를 인하할 거다. 뭐 이런 기대가 굉장히 컸었습니다. 근데 지금으로서는 전혀 그럴 것 같지 않은데요. 다음 연설은 이런 미국 페드, 미국 중앙은행의 통화 정책을 잘 설명하고 앞으로의 금리의 경로를 예상해 주실 분을 모셨습니다. 에릭 로즌그렌 전 보스턴 연방은행 총재신데요. 거의 15년간 보스턴 페드에서 총재를 하셨어요. 그리고 FOMC에 참여하실 때 제롬 파월 의장도 당연히 같이 있었고요. 옐런 장관과도 함께 일했었습니다. 이번 스피치 제목은 미국 경제는 왜 강한가? 그리고 이는 금리에 어떤 영향을 미치나입니다. 그럼 로즌그렌 총재를 모시겠습니다.
And then the final question you have to ask is whether you think underlying relationships are changing. So the previous speaker said that they thought that real interest rates should be around 3%. That's a really high number. So that 3% includes the period through the Volcker period, where both inflation and the Fed basically had to induce a very high unemployment rate to get inflation down. If you knock that period out and just look from 95, the Fed's calculation for the real federal funds rate is only 0.5%. Actually, it's 0.6% right now. So that would say that the Fed funds rate in the long run, according to the Fed, should be 2.6%. I expect it to actually be higher because I do think that productivity has been an important driver, but I don't think it's going to be nearly as high as what we have now. So I do think that we have pretty restrictive interest rates, and that over time, as inflation comes down, the appropriate monetary policy would be for a lower general trend to interest rates. But that has something changed in the relationship between how tight the economy is, and part of that is trying to explain why construction and auto sales haven't reacted to the higher interest rates as much as they have in the past. So another reason to think that there may be something different about this period than previous periods is what was generating the inflation. So what was generating the inflation in previous periods tended to be oil shocks. So that worst period in the 70s was a period of oil shocks and an unwillingness of the Fed to tighten the economy enough to slow the economy down to prevent it from getting into wages. Once you start having wage growth being much higher than consistent with an inflation target, then the only way to really get your goal is to have a recession. So one question is that going to be necessary to actually get down to 2%? I'll show you in a minute the graphs that show that inflation's come down quite a bit without a recession, which is a little bit unusual how marked the inflation rates come down, but it's because the nature of the inflation rate is quite different. So if you look at goods prices from the CPI, they're actually negative over the last year. So a good that you were buying last year at this time and this time, it's priced a little bit lower now on average. Where we still haven't seen as much of a slowdown is on the service sector. And the service sector has three major components. The most important of it is shelter. Shelter is gradually coming down. So if you, without going into the calculations of how we calculate shelter prices, it's tied to rents, and rents have been coming down. So the expectation is there'll be some additional softening on the shelter side. So inflation was generated by a different factor, and the pandemic, at least the supply shortages that occurred during the pandemic, were in effect temporary. And you see that in that the goods prices are back down to actually not being inflation at all, but actually being negative. So what we need to do is see the service sector also have the same response to bring that inflation rate down, but it certainly helps that good prices have already come down dramatically in the United States. So this gives you a much longer period of inflation. So there are two inflation indexes in the United States. This is the one the Fed focuses on. It's the PCE. The PCE is generated from the GDP report. It has a different characteristic than the CPI in that the weights change every quarter. So the good aspect of that means that if you substitute, if orange prices go way up, you might buy more apples. If I have a CPI and it says I buy the same amount of apples and oranges every time, the CPI won't calculate the fact that people have switched goods. The PCE actually will take into account the weight is higher now for the good that went relatively cheaper, And so the Fed tends to focus on the personal consumption expenditure index for its inflation target. Now, the first thing to notice is that the periods that inflation came down historically, and there are two lines here, the blue is core, so that just takes out food and energy. The reason we do that is because energy prices move very rapidly in short periods to disruptions, and so we're really trying to get the underlying price changes. So the Fed tends to focus on core PCE, even though in reality our target is for total. But since we can't really control whether Ukraine bombs oil wells in Russia or not, there's a reason to probably focus on things that are more directly relevant to the domestic economy. But you can see during each of these recessions, inflation didn't really come down till we had a recession. And that's true in each of these periods. You tended to get a lot of reduction in inflation right around when the recession was occurring, and then it would level off for a period with a slight downtrend. And that was kind of the pattern that you see all through. What's striking here is there's no recession shading. So inflation has come down. You can see where we were and where we are now. We're still not where the Fed wants to be. We're still at 2.7, 2.8%, depending on whether you use core or total PCE. But relative to where we were not so long ago, this is a dramatic decline, given that the economy has actually grown quite strongly over the last year and a half. So the question is, do we need a recession? Do we need a slowdown in labor markets to actually get down to 2% or not? I think that's an open question. Now, similarly, if you look at the unemployment rate, again, each of the recessions are when unemployment goes up. But note that even whenever the unemployment rate goes up by more than 4 or 0.5%, we've had a more severe recession. So we don't have periods where the unemployment rate got up by 0.5% without recession shading. But if you come over to here, we got as low as 3.4, we're up to 3.9, that's 0.5%. And there's no sign that we've had a recession yet. So the patterns, why did the economists get things so wrong? If you looked at when unemployment occurred, Fed tightening, unemployment goes up, inflation starts coming down. Economists basically use historical models. This period is outside of the historical realm. It's partly because we haven't had a COVID shock in the post-World War II period. So if economists really focus on data, and they basically describe the future by looking at the past, and the past no longer predicts what's happening next, you're going to get the kind of errors that we just saw. But it's important to ask, is that going to persist or not? Finally, the federal funds rate. And this just shows you the reason why we went into each of these recession periods. It was because the Fed tightened. So you go into each of these recession shading periods, it was the fact that the Fed became concerned inflation was going up too quickly, and it had to tighten enough to slow down the economy. You don't see a period where the Fed funds rate's gone up dramatically without recession shading, except for this period. So this is a very unusual period. So in part, the COVID shock is very different than the kinds of shocks we've seen in the US economy before, which means how well you can forecast the economy or interest rates is a bit limiting right now, because you have to decide, are we going back to this world or are we in a completely new world? So let's move more towards monetary policy. This is the statement from the last meeting. And it really highlighted there'd been a lack of further progress towards getting to 2% inflation. That came after a series of misses on both the CPI and the PCE, basically for 3 months in a row. We got reports that were higher than people were expecting. At the same time, the Fed was shrinking the balance sheet a little bit more slowly than it was before. But by intention, the balance sheet was designed not to really have much impact on interest rates, and that's what we've seen. And at the press conference, the one thing that the chair did highlight was he did not expect interest rates to actually need to rise. Why would that be? Well, I'm going to show you the more recent pattern for what's been happening with inflation, and inflation has definitely been trending down. As long as that's true, we don't need to tighten more. So, is the federal funds restrictive? I would say it is quite restrictive. Inflation currently is at 2.8%. The effective Fed funds rate's 5.4%. That is a tight monetary policy. It's not surprising to me that we are starting to see delinquencies for low-income borrowers. That's exactly the mechanism I would expect to start seeing that slowdown. Private wages and salaries actually is a challenge. That has not come down as much as the Fed would like. What kind of wages and salaries would you need to get a 2% inflation rate? Well, if you think about 2% inflation, and people, if you have a productive economy, wages should share in the productivity that's occurring in the economy. So let's say that the productivity is 1.5%. You'd expect wages to be around 3.5%, consistent with the 2% inflation rate. It's currently at 4.3%, using the ECI, which is the best measure of wage and salaries, using the private workers. So the Fed still hasn't gotten wages down to where it wants. We'll have to see if it actually gets down to a level more consistent with the 2% inflation rate. So this is the CPI. Now, what I've done is, instead of giving you a history from 1960, I'm giving you a history for just the last 3 years. Why am I doing that? Because you want to get a sense of, is the trend changing? So there's been a lot of hyper-focus on the last 3 reports. But if you look at this period for the core CPI, you can see the trend hasn't really changed. These are really small changes in an index where high auto insurance or small factors can make a big difference when it gets annualized over a year. But what you really have to be concerned about would be if you started to see a trend back up. There's no evidence we're seeing a trend back up. And if you look at most of the data underlying the CPI and the PCE, it seems consistent with this trend going down, but going down quite slowly. This is the PCE. The PCE, definitely the trend has flattened, but it's still been down. So why would I expect that the Fed has some flexibility to have a more accommodative policy? Because if we stay at this rate, we're getting a tighter and tighter policy, because the real rate is going up as the inflation rate goes down. So at some point, the Fed's going to need to lower rates just to be consistent with how much inflation rate has come down. So it is a pretty restrictive policy. We're seeing it actually improving the inflation rate, but it's improving at a fairly slow rate. Now, this is the ECI. This would be the counter evidence. If I wanted to argue why the Fed should not do anything, it would be, this looks like it's leveling off at a level inconsistent with 2% inflation. So the question is, with 3.9% unemployment and wages growing at 4.3%, what's going to generate that slower wage growth going forward? Now, it may be as prices come down, the wage demands also come down, but it's unclear. So this would be the argument if you're going to take the counter case. What do I expect? Now, first of all, I would highlight that almost everybody got the last year and a half wrong. So take my word of advice that there's a big standard error around anybody who forecasts, because there are two things. You're forecasting how the Fed will react, but you're also forecasting the economy. Do you think the economy is going to continue to be as strong as it currently is? So the reason I say the market basically is assuming one reduction, I think that's probably the best guess. But if inflation keeps a trend down and the economy gets a little weaker, which is what I'm actually expecting, I think the market could be surprised by actually a cut in September. But it would require something particularly important to happen, which would be a series of positive inflation reports consistent with that trend continuing to go down. If that trend looks like it's not going down, they're not going to ease policy till they start seeing that trend go down. What would you need? Something like a core PCE getting close to 2.5%. Again, that's just dropping by about 0.1% over the next several months. But that's probably what you need if you're actually going to get further cuts. I would disagree with the Fed. They actually think the long-run Fed funds rate is going to be 2.6%. That implies a very small real interest rate. I don't think that's consistent with what they're doing or consistent with the productivity gains that we're likely to see from AI. I think there are going to be a lot of reasons. The federal deficit's very high. For all those reasons, I expect that actually the terminal Fed funds rate is going to be much more like 3.4%, so much higher than the Fed's currently forecasting. In a sense, this is going to be a soft landing. Now, given how wrong the forecasts have been for the last year and a half, you should definitely talk about what the risks to the forecast are. And so I want to end with this slide, which is talking about the risks.